All right. Well, hello, everyone. I'm Josh Alballero with Iugo, and the rest of my team here is going to assist me in bringing this live workshop for you. We are here from home, so we're also broadcasting on Facebook. So let me just go ahead and check to make sure that we're actually successfully. Christy, you want to check your Facebook? Make sure that we have audio. We have audio. Great, great, great. So welcome everyone to our live workshop for self-employed individuals. And we are live on Facebook. We are live on Zoom. We are live on YouTube. So if you have access to those channels, welcome. We're still having some more we still have some people still logging in. So hey Jordan, hey Christy, if you figure out the chat system, drop a go ahead and drop a message there. Prepare your questions. This is for you. This is for you. So you know what I mean by that is that we want to spend most of the time answering questions. Whatever questions you have, we do have a planned agenda. But we want to spend more time on what's important, and that's answering your questions. So with let's do a small presentation of Iugo and IOOGO. Iugo means to connect. We want to connect you, our customers, to simple financial solutions. As you can see, we make tax and accounting ridiculously simple. Technology has evolved, and with that, tax and accounting has become a little more simple, a lot more simple than when it used to be. Now, if you have people telling you that's not truth, is because they want you to not know how simple it is or how simple it can be, so they can continue to charge you a lot of money. We do a little bit of the opposite, right? We want to make sure that you fully understand this. Now, are you going to come out as a trained tax preparer out of this workshop? No. Are you going to become a CPA with this 1 hour workshop? No. Are you going to be an IRS enrolled agent like myself after this workshop? No. But you will have the awareness, right? You're going to be aware of the important things as a self-employed individual. And if you already know some of this stuff, you could more, you could, it could be serve as reassurance, right? So as I was talking to you about Iugo, let me show you Iugo. What do? We are a software company that also has a service side, and we work with a team of CPAs and enroll agents and bookkeepers. And we do both things, right? So we build software, accounting and tax software for our customers. Do it yourself. So if you want to do your own taxes, if you want to do your own books, and if you don't want to do that, then we also have a suite of services. But we're not gonna sell you things today. That's one of the things that we don't do in this workshop. So we don't sell things. We really want you to learn. We really want you to ask questions. We really want you to walk away more knowledgeable, more secure about the path that you have taken or that you are about to take. So one, we don't sell. Two, we don't have a formal Q&A. So the boring Q&A at the end where you're having to wait for people to finish their questions so that the workshop can be done. No, we don't have that. So as we are going through the topics, if you have a question, drop it in the chat system, and I'm going to answer it. This is a live workshop. So as you can see, I'm going to get distracted a little bit because we still have people coming in, and I am here at home. So this is a live workshop, and enter your questions and I'll answer your questions. So we're going to focus on federal law. We're going to focus on principles of accounting. We're going to make it fun. We're going to make it realistic. This is not you. I'm not your accounting teacher, so it's not going to be boring. So without further ado, let's go into the agenda and what we're going to cover, right? So we're going to talk about tax prep, accounting, how that relates to tax prep. We're also going to talk about finance support. We're going to talk about payroll taxes for self-employed individuals, income taxes, credits and deductions, and resources. So I want you to pay a lot of attention. And if you want the recording of this workshop, we're going to have it for you at the end of the day. So don't worry about it. Don't worry if you sign up, you can make it. Life happens. But what better to do right now than to be in a workshop, right? So anyway, so let's talk about the first topic. And again, I want to say I want to welcome everyone who is here. And if you are watching us in Zoom, if you sign up through Zoom, I have your name. If you're watching us on Facebook or you're watching us on YouTube, I don't have your name. So Alexandra, Jenna, Megan, Veronica, Lisa, and am I pronouncing this right? Am I not pronouncing it? Yeah. Give it. Hello. And everyone else who's watching us in the different channels. Hello, welcome. So let's talk about preparing for taxes. And I'm going to assume that you know some of this stuff. But at the same time, I'm going to, do some explanations, and I'm going to bring this to, I'm going to take away the boringness of banking and accounting, and you should do this and you should do that. And let's really talk about what's happening now, right? So when we talk about preparing for taxes, right, and we talk about the looming day, the upcoming date of July 15th, because if you're a self-employed or if you're a U.S. taxpayer, your tax deadline was April 15th. Everybody knows that, right? April 15th already passed. Today is April 22nd, which is my birthday. Happy birthday to me. So if you are a U.S. taxpayer, whether you're self-employed or you're an employee of a company, tax deadline was April 15th, but now is July 15th. So guess what? You have a lot of time to get your records ready. You have a lot of time to comply with that deadline. And the Treasury is saying that the IRS is saying, look, if you can't make it, right? Because we're playing this thing by ear right now, right? July 15th is the new deadline, but who knows if that is going to be the deadline, right? So, but let's say that is, right? July 15th is the deadline. But if you can't make that deadline, you can also ask for an extension, and that will extend the deadline for you to October 15th, right? So I want to be clear, and I'll talk about deadlines here in a minute, but I want to be clear. It will extend the deadline to file, not to pay, right? So I'm going to go into details on what extending my deadline really means. All right. So bank account and records. Why is it so important for a self-employed individual to have good banking relationships and banking records? Let's talk about the paycheck protection loans. So I think that's a good topic to cover, right? And paycheck protection loans. A lot of self-employed individuals found themselves in a real tough time to apply, to the point where some of them just gave up and said, you know what, they're giving the money to the big players anyways, to the big businesses, and not to us. And that's another topic, right? But we do have examples. We have both cases, right? In our network of clients at Ayugo, we've seen those self-employed individuals who treat their business as a business, right? Not as a side gig. What I mean by that is that banking records are spotless, and this is why I'm going to, I'm going to get off my soapbox here in a minute, and I'm going to tell you why this is so important, what you should do, right? Banking records are spotless. Banking relationships are also spotless. So you're shaking hands and you're making that relationship with your banker, so you are treated as a business, right? So now we have a couple of self-employed individuals who are making good money, and a couple of them who are not making good money. There's one of them, one of the self-employed individuals. Let's call him Michael for this example, right? Michael has a bank account at Bank of America, and he keeps all his records. And he doesn't make great money. You know, he's starting out. You know, he's in his second year of self-employment. He's registered as a DBA, not as an LLC, not as a corporation, right? So DBA means that Michael is the business is Michael, and you know everything's commingled, no separation. But Michael opened a business bank account, right? So he keeps his personal banking and his business banking separate, and because of that, we've seen a better relationship, right, with the bank, because you have made the decision to treat your business as a legit business, right? Even though you're still you haven't incorporated, even though you haven't become an LLC, your records, your tax records are your profit and loss statements are great. Your tax records are in order. Everything's in order. So you made the decision. You made the decision to treat your business as a legit business. It's not just a side gig, something that I deal with at the end of the year, right? So I want you to walk away from this with the idea of, if I'm not treating my business as a legit business, then I need to start doing that now. Because on the other hand, we have John. John makes $200,000 as self-employed, but all of that money comes into his personal bank account. John is too busy being busy that he's not paying attention to the other pillar of his business. And when we look at the pillars, right, if you want to write this down, right, the three pillars of any business: clients, sales, and finances. They go together, the three pillars. There are other important aspects of the business like marketing and legal and all that stuff. But, without customers, you have no business. If those customers are not buying, you have no business. And if you cannot understand your finances, you have no business, right? So those are the three main pillars of the business. And John doesn't take care of any of that. He makes about 4 times what Michael makes in revenue, but John, it's all over the place, right? John has walked to his bank many times, and the bank has told him, "Hey, open a business bank account." John says, "No, I'm okay now. The money is the same. The dollar is the same value anyway, so I'm not gonna do it. I'm not gonna do it." Guess what? Paycheck protection loans came in, right? And John gets put in the very back of the line, right? There's another line that wraps around the corner, and there's John, because he doesn't treat his business as a real business, right? And Michael, who makes 50,000, John makes 200,000. Michael is the preference, right? Bank accounts and records are very important, and this is why you're here today, right? So the second point is to be mindful of your tax deadlines and extensions. And I just talked to you about that a few minutes ago, and I said, hey, you need to understand you have a quarterly deadline that you can choose to follow or not follow, and I will tell you why I say that. And then you have a yearly deadline, which is your April 15th. You have to do your Schedule C. You have to do your tax return at the end of the year. And what happens when you don't respect those deadlines? And that means penalties, right? And extensions, right? And if I want to avoid a potential penalty, then I file for an extension. But let's go ahead and make a quick stop here, and let's understand extensions, right? You probably already know this. You may not know this because you're starting your business in 2020, or you started it last year, and you're trying to understand, right? What do I need to do? How do I do this, right? Extensions. If you're going to file for an extension right now, you don't need to do that. Why? Because the government itself, and I'm going to repeat this for the people, for the people that just joined, the government extended the deadline from April 15th to July 15th. So you don't have to file an extension. There's nothing you need to do. Just make sure that over the next 60 something days, you get all your stuff ready so you can file your taxes. If you want to file your taxes tomorrow, go ahead and file your taxes tomorrow. You don't have to pay. If you owe money, you don't have to pay it until the 15th of July, right? So July 15th comes around and I file my taxes, but I can't pay. Okay. So I'm going to say that one more time. July 15th comes around. I file my taxes. I owe the IRS $2,000, but I can't pay. So what do I do? And this goes hand in hand with extensions, right? Because there is a misconception out there that, you know what, I'm not going to file my taxes. I'm going to ask for an extension, and then I'll file and pay. So let's understand that the deadline of July 15th, that is the deadline to file and pay. If you ask for an extension, which means that your time to file will be extended to October 15th, you will only get an extension to file, but not to pay. What does that mean? It means that the government can go retroactively to July 15th and start adding interest and failure to pay penalties, right? So you can ask for an extension to finish your taxes, but not to pay. The taxes are still due July 15th. So I think you get the point. So mindful of that. Be mindful of that. For those of you guys, for those guys, for those self-employed individuals who want to contribute self-employment or you want to contribute estimated payments every quarter, we're going to talk about that on the next few slides, and I'm going to break it down very nicely and easily for you, right? So again, remember, we don't have a formal Q&A. If you have questions, I have my team here that will help me. They'll help me with the questions, and I'll read them. They'll read them to me, and then I'll answer the questions. So go ahead and drop your question on the chat. We don't, and yeah, so make sure you send it to everyone, and then we'll get it, we'll read it, we'll talk about it, we'll make some conversation about it. This is important. We want to hear from you. So this is about you, okay? So all right, so let's talk about the profit and loss statement, and I'm going to break that down really quickly, because one of the challenges that a lot of self-employed individuals have is understanding the need for this profit and loss statement. And when we talk about the profit and loss statement, right, we begin to think about this accounting report that is so complicated to make, and that, I'm not an accountant, so I'm not going to do it. Look, don't get confused with the names, right? Don't get the name profit and loss statement, it's an accounting term, but in reality, what it means is, do you have a profit or do you have a loss? And how do you calculate that? Simple math. How much did it come in? How much did it go out? And what do you have left? The perfect example right here in your screen is a profit and loss. It's a simple profit and loss of how much money came in. $33,766 came in, right? This is an example. And then below you have the expenses of $3,402 with 41 cents. This is a business with very little operations. There's a lot of businesses like that, like consulting, and there are a lot of businesses who don't have a lot of operational cost, and they're highly profitable. Accounting is one of those, right? Highly profitable. Tax preparation is one of those, highly profitable. There's not a lot of operational costs. So your net profit is $30,364. That there on the net profit is where the IRS will calculate taxes, right? So that's what we need to understand. What you need to understand is that a profit or loss, this is something you can build on, and I'm going to use extreme cases, right? You can grab a blank sheet of paper and write it yourself, right? This is not something that you need to get too technical about it. Where are you getting your money, right? How are you spending your money, and how much of it is left? That is what you need to do on a monthly basis, right? Simple as that. But I know I went to the extreme and I said a piece of paper. Let's go to the next extreme, the less extreme, Excel, right? Everybody knows Excel, right? If you have a Google account, most business Google accounts have a version of Excel. There are so many versions of Excel out there. There's so many applications out there that you can download for free or for a couple of bucks to download to organize your transactions. your bank also offers some sort of a software, right? And but let's say Excel, right? A simple column or a simple cell that says, income, and you break down your income and then the expenses, and then you calculate, and then you have your monthly expenses. But let's go to what really happens most of the time nowadays, and that is your version of QuickBooks, right? You're going to have a self-employed version of QuickBooks. It's going to cost you $10 a month. I cannot afford $10 a month. Come on, you got to start treating your business as a legit business, right? It's an expensible. If you spend $10 a month, $120 a year, it's an expensible a deduction, right? It's a deduction at the end of the year, right? Tax deduction at the end of the year. So, so it's coming out of your pocket, but at the same time, it's not, right? Tax deduction. So profit and loss is very important. If you get into the habit of building a profit and loss on a monthly basis, it's going to take you 30 to 60 minutes max. Because if you are in the infancy stage of your business, then you need to sit down and really put your head down and understand the numbers in your business. And then I get this the typical response of someone who's not really engaged in their business, and they say, "Oh, Josh, but I'm not an accountant. I don't want to be an accountant." Look, you want to be a business owner, and I'll tell you this: there's no successful business in history where the founders did not do accounting for their business, at least for the first few months, right? You talk about Jeff Bezos, you talk about Bill Gates, you talk about all of these big businesses, right? That when they first started as self-employed, because they were self-employed, they had to do the math and say, okay, this is how much money we have in sales. This is how much money we have in expenses. This is how much we have in profits. And this is what we're going to use those profits for, right? So don't let anyone out there tell you, hey, you shouldn't be doing your own accounting. You shouldn't be doing your own books. You got to let somebody else do it. Now, look, it's in my best interest to tell you, hire me, hire my team. No, but what I want to do today is to tell you, if you are in the infancy stage of the business, if you are bringing in less than $10,000 a month, right, then you should be doing your own bookkeeping so that you can fully understand the numbers. So when you go to a bank, you can clearly explain why you need that loan. So when you go to a lending institution, right, any lending institution, you can clearly articulate why is it that you can pay, how is it that you can pay this loan, right? One of the biggest challenges that a lot of business owners have, a lot of self-employed individuals have, and I used to have that, right? Anyone who's a business owner, we all had those problems. We are, if anything, I'm speaking here from experience, right? From the experience of many, many years ago, that, look, it was so hard to get out of the habit of not taking care of my books. And I wasn't, my business is bookkeeping and accounting and taxes, right? But it's so hard. It was so hard. But then I had to face the reality that my business stopped growing. I could not invest anymore in technology. I could not invest anymore in employees. I could not invest anymore in buildings and locations because no one wanted to lend me any money because I wasn't, my paperwork said so, right? My paperwork said that I was not a good candidate for a $5,000 loan because I couldn't explain how I was going to pay it because my paperwork was all over the place, right? My client's paperwork was great, but mine was all over the place. So, and that is, it's important that I tell you that because, I don't want you to come out of this workshop thinking, oh my God, I'm doing everything wrong. No, we all did. All of us did, right? So, so that, I want you to understand the profit and loss statement, because what we tell our customers is, what we teach our customers is, if you build the habit of sitting down once a month, 30 to 60 minutes, it's 1 hour a month. It's your business needs that, right? Once a month, and you build your profit and loss statement on a monthly basis, guess what? When you finish December's monthly P&L, profit and loss statement, then you close the year. You're done for the year. And you get in that habit, right? 1 hour, right? And then 1 hour, I'm going to work on December. And when I close December, I've closed the entire year. And now I'm ready to do my taxes. So the biggest challenge that most individuals, self-employed individuals have when it comes to tax preparation is not that taxes are complicated, right? I have a shirt right now that says taxes are simple, because they are. When you look at it, taxes for self-employed individuals have not changed in the past 25 years, right? They haven't. It's the same thing, right? Maybe the past 15 years, it's the same thing, right? They've added a couple of things here and there, but it has not changed. The basis of it has not changed. And I'm going to talk to you about those bases here in a minute. But I want you to understand that when you focus on your business and doing the paying attention to the accounting of your business, to the books, things become more clear. So, okay.
Alexandra wants to know, can I use personal checking account from Bank X and credit card of Bank Y for my business expenses? Can I use personal account for business expenses records at all, or I must have a business account?
So, Alexandra?
Yes.
So, Alexandra, that's a great question. I'm going to tell you this, right? There's no law that says that you cannot use personal accounts. There's no law. There's no accounting principle that says, no, you have to use business. I think it goes towards, the point that I was making earlier, that if you want your business to grow, right? If you want your business to go in the right direction, you are going to separate. I'm going to give you an example. I'm going to give you a reason why, right? I talked about the loans, the PPP loans, right? Where the banks made they play the preference, right? And they gave preference to the businesses who were, in a better situation, that could present their business statements, in a better situation, right? Such as, here's my business bank account, and here is my business checking account, and here's my profit and loss, right? This is personal and this is business, right? So then the banks gave preference to those businesses, no matter how small they were. If you could present that your business was separate than your personal, here's your preference, right? So that's one. The other is when your business is growing and you're making transactions, and every time you make a transaction with a customer, you gain money, but at the same time, you put yourself at risk, right? And, anytime we do that, we put ourselves at risk, right? When you sell something, you're gaining, right, the benefit, but there's also a risk that the customer could come back for a refund or a complaint or something bigger than that, right? So you want to keep as much separate as possible in the event of something going wrong, right? And we're not going to talk about LLCs and incorporations here today, but that is something that should be in the back of your mind at all times. It is beneficial for a business to be separate. Now, I understand credit cards, right? Credit cards, and I'm going to give you an example. There's a we have a couple of customers who use a personal credit card for business, because that's the only credit they can access. They've tried to go to Bank of America. They could try to go to all these other banks, and they won't give them credit cards. So what happens is that at some point you need to start, and I know this is hard, but at some point you need to start limiting how many personal transactions you do to that credit card, because you are now labeling this a business credit card, even though it's a personal credit, right? You're labeling this. So one of our customers has a Capital One credit card, personal, and I believe it's a Chase personal credit card. And the Capital One is the one that he uses for business, right? Only for business. A long time ago, he stopped using he stopped putting personal transactions there. So let me know if I answer your question. To summarize, there's no rule that says that you should only use business or just personal. It's what's good for business, right? So Can you, I think another chat came in.
Also, Alexandra, it's her second year in real estate. She's
Huh.
told multiple times to wait with creating business account until her RE work starts to bring substantial income. What income amount would that be?
So I would say don't wait. I would say don't wait. So I know I just told you there's no person, there's no rule. Let's just use experience as an example, right? You know, when I engage with in consulting, whether it's free or pay consulting, when I engage with someone, I say, hey, here's what you need to do. Number one, I want you to stop working under your own name, right? Stop working under your own name. Go get a DBA. Start there. And then people will say, well, that DBA is the same thing as my name, to a point. But you begin to separate, right? You're trying, right, to separate. Go get a DBA, doing business as, and then go get a checking account, right? Go find a bank that will give you a free checking account, or it'll cost you a couple, 10, 20 bucks a month, right? And begin to do that, right? That is because you never know when the business is going to go from here to here. Look how volatile business is, right? You can go from here to here very quickly, and you can come from here to there, right, very quickly. So that would be my advice, right? It's and when you talk about what amount, right? What amount? Think about the amount. And I got this from one of our partners, one of the lawyers, right? That we work with, one of the attorney firms that we work with. He says, hey, think about the amount of money that you would like to get sued for. $1, $2, $5, $10, $200,000, right? That is the reason why you want to begin to separate, right? So the amount of money, it's unknown. What is the amount? I think that as you see the business pick up more and more and more and more, you want to legitimize, your business even more, right? Even when you're going to make a business transaction or you're going to write a check, right? You don't want that check to come out of your own name. You want that to come out of the business, right? So, Alexandra, hopefully I answer your question. Keep those questions coming. So let's move into finance and accounting. Finance and accounting, and remember how I told you at the beginning of the workshop that I was not going to sell you anything? Well, I lied. I'm just kidding. I'm not going to sell you anything. All I'm going to tell you here is I want you to know your options, and I already said some of this stuff. I'll get in a second. I already said some of this, but I want you to understand. One of the questions that I get the most, that we as a team get the most, is when should I hire an accountant? When should I hire a bookkeeper? And I always tell people, do it when you start to feel the oh crap moment, right? That, oh man, it's getting busy, right? Like Alexandra was saying, right? It's, things are, when things begin to pick up, right? Well, you start seeing, all of a sudden you're working with 2 customers, and then it's 4 customers, and then it's 5 customers, and it's like, oh my God, what do I do, right? And so when you begin to feel that, that emotion, right, that things are getting busier, that's when you need to say, hey, you know what? I'm going to send this off to someone I trust. I'm going to get the help. But for now, do it yourself. You need to understand all the financial components of your business. Then the second step, when things get a little busier, do half yourself. Get someone to help you. And then it gets real busy, starts getting busier, and then you say, okay, no, now I'm going to come in just for the updates on how my business is doing, and I need to make financial decisions. Right now I'm going to hire a professional, whether there's a bookkeeper or an accounting firm. Big differences. Bookkeeper, operation, accounting firm can help you grow, can help you think about the future, can help you plan taxes, right? Those are the difference, right? Bookkeeper, code transactions, build a nice P&L report. Accountant, they can do all of that, but they'll help you grow, help you think about the future, help you save taxes and things of that nature, right? A good accountant will do that. So you want to make sure that you know your options. The worst thing that you can do as an entrepreneur or as a self-employed individual is say, you know what? I have this idea of starting a business, and I get a lot of that. A lot of people come to me that way, and they say, hey, Josh, I have an idea to start this business. I haven't started yet. It's just an idea. But the first thing I want to do is talk to an accountant about doing my books. And then the question is, what books? I can give you advice for free. Come talk to me. Our team does that. We love doing advice for free. We'll sit with you for 30 minutes. Let's hear your idea. Let's point you in the right direction for free. A conversation about your business shouldn't cost. A conversation about the idea of your business shouldn't cost you any money. Okay. So let's talk about that idea you have. And let's point you in the right direction. All right. But I'm not going to do your accounting because you have no transactions. The first thing you need to do is go sell something. Sell, sell, sell. Remember the 3 pillars, right? Customers, sales, finances. What's that question?
It probably leads into the next one a little bit.
It leads into the next one. All right, cool.
Let me go ahead and ask it. Lisa wants to know, what is the best way to pay yourself from a business account?
The best way to pay yourself from a business account, if you are self-employed, I'm going to give you, and this is Lisa, that's a very good question. If you are a self-employed individual and you want to pay yourself, the best way to do it is to take a draw, what I call a draw, right? What's a draw? Draw is money, and correct me if I'm wrong, all of us who have been self-employed at some point, we have to do this all the time, right? We put money in the business, then we take it out, right, to use it, and then we put it back once we make it, and then we take it out again, and then we put it back in the business, and we keep going like that, right, for a while, right? Because we are self-employed. We don't know when the money's going to be there or it's not going to be there, right? That's the life of the beginning self-employed, right? And so it's really hard for me to say, as a self-employed individual, I'm going to give myself a W-2, right? Or I'm going to give myself a salary. It's very hard to do. Now, you will get to that point in business if you do the right things, if your business grows, if you make a lot of sales, right? You will get to that point where you're going to say, hey, you know what? I'm going to pay myself a check every week or every 2 weeks, right? I'm going to write myself a check. But in order for you to do that, you need to have a good stash of cash for you to be able to plan, right? Or at least have a bunch of bills that customers have to pay you, so you know that money is coming and you're going to be able to pay yourself. So as a self-employed individual, my recommendation is that you pay yourself a draw, right? When the money is available, you write a check from your business account to your personal account, right? So to give you an example, Ayugo is the business. I am Josh Albayero, right? Let's say that I am a self-employed individual and my company is called Ayugo, right? So I'm going to pay myself $1,000. I have $3,000 in the bank account. That's it. And I feel like, because I feel that right now is a good time to pay me $1,000. So from the business account, I'm going to write a check to Josh Albayero, and then I'm going to go and deposit. All right. Let's talk about technology, right? Instead of writing a check, I'm going to make myself a transfer from bank to bank, right? I'm going to make myself a Zelle transfer, a PayPal transfer. I'm going to do a direct bank transfer. You don't have to write yourself a check. As long as there is record that it went from here to there, that's what you want. I'm going to make myself that transfer. Now I have $2,000 in the business account and I have $1,000 on my bank account, and there's clear record of what happened, right? So what happens? Then I do more sales, and then I do more work, and the business is telling me that it needs more money. The business says, hey, Josh, I need $1,000. So guess what? As a business owner that I am, now I'm going to take $1,000 out of my bank account or my savings or whatever, and I'm going to put that into the business, right? So guess what? I just transfer the $1,000 back into the business, and that's typically what we do, self-employed individuals, right? We as I said before, we paid ourselves, then we put some of that money back into the business, and then we keep doing this, right? That's what we call draw. right? A draw, right? And that way, at the end of the year, I'm not having to pay a bunch of taxes, right? With, for money that I'm putting back into the business, right? So I'm going to explain that a little better. If you make an initial investment into the company, right? I made an initial investment of $20,000 into the company, and then I take 5 out, but then I put it back, and then I take 3 out, but then I put it back, and then I take 2 out, and then I put it back, and that is what I call a draw, right? I don't have to pay taxes on that because it's money that is doing this, right? It's the initial investment that is coming in and out, in and out, in and out, right? Here's the other way you pay yourself. You simply write yourself a check, right? Out of the profits of the month of the business, you write yourself a check, okay? And it's not the same as a draw. This is money that is not going to go back into the business, okay? Let's say that in the month of March, I did $5,000 in sales, and after paying all my bills, I can pay myself $2,500, okay? Paying all my bills, I can pay myself $2,500. So I write myself a check for $2,500, okay? So that money is never going to go back into the account. I am going to use those $2,500 to pay for my house, to pay for my car, to pay for my daycare, pay for all the personal stuff, right? That is what we call self-employed taxable income, right? You pay yourself $2,500. That means that at the end of the year, that money is going to get taxed, and this leads into what we're talking about right now, which is payroll taxes. So what I want to do is I want to start. There's 3 points right there, Lisa. I hope that I answer your question. There are 3 points right there, and quarterly taxes, self-employment taxes, and then the deadlines. But I want to start with point number 2 because it goes hand in hand what we were talking about. So can you put the white screen or the whiteboard? So remember, guys, that if you want to connect with me one-on-one, I have to stop sharing. Okay. If you want to connect with me one-on-one, you can do so. There's no charge for us to have a conversation, 30-minute conversation, Zoom conversation. All right, so we're going to talk about here. Let's label that. Let's say that this is called self-employment taxes. And Lisa, I just talked about self-employment taxes, $2,500. You pay yourself $2,500, and this month, next month, you pay yourself $1,000 because that's how much the business allowed you to pay yourself, right? And let's say that throughout the year, you end up paying yourself $10,000. So month number one was good. You were able to pay yourself $2,500. The next month wasn't that great, and you end up paying yourself $1,000. And hopefully it's not blinking like this for everybody. And then for the rest of the year, it was on and off. And at the end of the year, you end up paying yourself $10,000. That's what you pay. That's the total amount of self-employment income that you pay yourself. All right. So I want you to pay attention. I want everyone to pay attention. Please write it down. Self-employed individuals, the reality of self-employment is that we pay 2 types of taxes. Tax number 1, we pay 2 types of taxes. Tax number 1, it's called marginal tax. Oh my God, here are those terms, those tax terms that no one can understand. Marginal just means that you and I, Christy, everybody pays taxes. That's marginal. Everyone pays taxes. Everyone pays marginal taxes. If you're an employee and you get a W-2, you pay marginal taxes. Box number 2, box number 2, federal income tax withheld on your W-2, marginal taxes. Okay. Well, A self-employed individual pays 1, marginal taxes, 2, self-employment taxes. So you pay 2 kinds of taxes. And this is why your tax bill could potentially be higher than when you are an employee, or it looks higher than when you were an employee. All right, so let's do this. I am single. I am a single self-employed individual with a $10,000 income. All right. So what is my taxable rate on $10,000? Basically 0. My marginal taxable rate on $10,000 is basically 0, right? There's no taxes, right? But guess what? Self-employment tax gets calculated at 15.3%. So what is 15.3% of $10,000? You don't have it. $1,530, right? No, that's them. Yeah, right. Type of accountants are we? Why $1,530? There's your self-employed taxes, right? So wait a minute. My marginal tax, my first tax was 0, right? Because typically from 0 to $999 or $9,999 is it's like a couple dollars, but let's say 0 for this example. But guess what? Self-employment taxes gets calculated differently, because what self-employment tax means is, or what self-employment tax is, your Social Security contribution. So I want you to write this down. Self-employment tax equals Social Security contribution and Medicare contribution So the last thing I'm going to tell you here is that when you are self-employed, you represent both the employee and the employer. The employee and the employer. So when you used to have a job, when you had a W-2 job, right? At the end of the year, they gave you a W-2. And you looked at your W-2, you saw box 1, my salary, box 2, my taxes withheld, box 3 was salary to calculate Social Security, and box 4 was salary to calculate Medicare. Okay? So when you are an employee, you pay your portion of self-employed, you pay your portion of Social Security and Medicare. When you are self-employed, you have to pay your portion and the employer's portion. Okay? So that's why your taxes are 7.65 higher. So you want to write that down? Your taxes become 7.65% higher when you're self-employed, because you have to cover the employer portion of Medicare and Social Security. There's no way around that. Yeah, you can decrease your income by increasing your expenses, but then you're risking an audit, and we'll talk about that in a minute. But I wanted you to understand this, right? We pay marginal tax, and we pay self-employment tax. Okay? So typically when I have credits, when I have kids, and I have young kids, and I get the child tax credit, typically that child tax credit is going to help me pay for the marginal tax, right? And it's also going to help me pay for the self-employment tax. But when I'm single and I have no credits, then I'm going to end up with a tax bill, right? And I just gave you an example of $10,000. Imagine if that number is $50,000, then of course you will have a marginal tax implication, and also a self-employed implication. So what I want you to take away from here is that you have 2 taxes to be aware of as you begin or you continue your self-employed career. Do we have questions?
Yes, there was a question. If Megan wants to know, if business is based out of her home, how does she claim portion of utilities and mortgage under business expenses?
All right, so we'll cover that, Megan. We'll cover that here in just a second. We have a section just for deductions. and we'll take care of that. So, all right, let's yeah, stop sharing so I can take over here. I think yeah, there we go. So, yes, there we go. All right, so now that you see my screen again, we talked about self-employment taxes. Let me cover quickly quarterly taxes, right? If you're a self-employed with consistent income, you have to pay quarterly taxes. Quarterly taxes will do this for you. It will kill the monster of uncertainty that comes at the end of the year. That monster of how much taxes am I going to have to pay? My surprise of how much taxes are due, right? Quarterly taxes are estimated based on last year, right? So, you know, and this is a very good time to tell you, right? For quarter one estimated taxes were put on hold, right? So I want to make sure that you understand that they were not canceled, they were just put on hold. What does that mean? That you don't have to report or pay your quarterly taxes for quarter one of 2020. You don't have to do that right now, but you will have to do that come July 15th. Okay, I want you to pay attention to that, right? If you are a self-employed individual who is consistently paying quarterly taxes, right? Your quarterly taxes for quarter one are not due until July 15th. So you're going to have to report quarter one and quarter two in one place. You're going to have to do two forms and report them the same day, pay the same day. Okay, so very important. And then tax deadlines and penalties. We already talked about the deadlines, which is July 15 right now. Typically, you have a quarterly tax deadline. So you have January, February, and March. So April 15th, you have to pay the first quarterly. And then you have April, May, June. So July 15, you have to pay. And then it's October 15th. And then it goes on to the next year. January 15, you have to pay for the last quarter, right? So that's quarterly quarterly tax payments. Now, what I want you to understand is if you don't have consistent income, you are not responsible or fully required to pay quarterly estimated payments, right? If you're only doing, side gigs, like let's say Uber, right? You do, January and February, you do Uber, then you don't do, then you do it again during the summer, then you do it again at the end of the year, and it's not a consistent thing, then you report your self-employment income at the end of the year. And if you go to a tax pro that understands this very well, what they're going to do is they're going to annualize your income, right? And therefore, you're not going to be required to pay penalties, right? So, but if it is determined that that's not your case, then the IRS could come back and say, hey, you have to do quarterly tax payments, and if you don't, we're going to penalize you for doing that, right? For not doing that. So, all right, let's move on. And we talk about income taxes, and we talk about the expenses. I want to cover expenses, and I want to start with Megan's question, right? Megan talked about how do I deduct the home office, right? And I want to tell you there's two ways of doing it, okay? The first way is the simple method, the one that I recommend the most. The simple method simply, right? The simple method is a calculation of the square footage that you're using. And I want you to understand this exclusively and regularly for your business. For instance, I am in my home right now. We use this office for business. Nothing else happens here, right? I'm not gonna lie, right? Maybe 98% of the time business. The other 2% I'm here in the window looking outside, right? So but it's used for business, right? So I'm gonna give you an example. I'm gonna say that this room right here, it's 275 square feet. You have to know these things. 275 square feet. Okay, so the simple calculation that I'm going to do here on my phone calculator, but I'm sure you're going to do it on a software, right? On if you do TurboTax, or if you do Ayugo tax, or if you do whatever you do, right? You're going to do it on a software, and the software will do the calculation for you. But I'm going to do it here so you can see it, right? The potential deduction that I can get for this room is $275 square feet, 275 square feet times $5. Why $5? Because that's what the law says, right? So 275 times 5 equals $1,375. That is a deduction. That's not a credit. It's a deduction. Deduction is good. Deduction means less taxes I have to pay. Less taxes I have to pay sometimes means that I can get money back sometimes. Okay. So that's the first way to do it. The second way to do it is that you will go expense by expense, but this gets a little more complicated, right? Because then you need to understand what is a direct expense of the business and an indirect expense of the business. And I'll give you an example, and I'm not going to go any further than that. A direct expense for this business is the internet connection, because we have the internet primarily for the business, and then we use it for something else, right? Then we use it to check Yahoo or check, or Netflix, right? But the primary use of the business, of the primary use of the internet, is for business. That's a direct expense of the business. Then what I'm going to do is, since I pay $200 a month, then $200 times 12, right? That's $2,400, right? Is that right? $200. Yeah, that's $2,400. And it looks like, and it looks like I'm going to get, a bigger, what do you call it? It looks like I'm going to get a bigger deduction, but I have to know how big my house is and how much of the house am I really using for the business. And then I have to go into the percentage of the bill and things of that nature, right? So it's a lot easier, especially if you have a room. If you use a room that's 300 feet or less, square feet or less, then it's easier just to take the standard deduction. The indirect example is home insurance, right? I have to pay for home insurance, despite the, whether I have a business in the house or not, I have to pay for home insurance. So the primary use of that expense is not the business, right? The primary use is just, it's a personal, right? So it's a lot easier to take the simplified method, which is what I explained earlier, right? If you have a room that's 300 feet or less than 300 square feet, you multiply that by 5, and then you get a nice chunk of deductions. What I can do also, Megan, is I can send you a video. Can we do that? I'll send you a video we have made specifically for home business deduction, and you'll understand it very well. It's a 3-minute video. All right. So hopefully I answer your question, Megan. Let's talk about depreciation. Depreciation is very important. If you own vehicles, if you have vehicles, for all of you guys who are Uber drivers, for all of you guys who are construction drivers or construction owners, right? If you're in real estate, right, there is a depreciation impact to your vehicle, right? You can depreciate your vehicle. If you bought, for you guys who are real estate agents, you have to, most of you guys have nice vehicles, right? You can depreciate the cost of that vehicle on your tax return. Go to a tax pro that can help you. You don't want to get into how the depreciation works. You need a class for that, but it's something that you need to understand. How can I depreciate the cost of my vehicle? How can I depreciate the cost of my $30,000 vehicle for Uber driving, or for my real estate agency, or for my construction company? And so keep that in mind, depreciation, okay? And then we go into meals and entertainment. This is a very good, and there's all sorts of deductions that you can take, but I'm only covering those that are very, very, very important. I'm gonna those that have a real impact, right, on the business. So meals and entertainment. Remember, meals, you can still deduct meals. on your tax return, right? Meals that are related to business. Meals that are related to business. Entertainment, that's a whole different thing, right? The challenge with reporting entertainment now is that the government wants to know that there are specific rules for entertainment, right? And then meals, remember the meals, the IRS only covers 50% of business meals. So give you an example. I spent $5,000 in meals because I ate outside. I ate out. My business is out, so I eat out. And then the IRS says, all right, that's awesome. You spend $5,000, you eat very well. That's awesome. Well, we're only going to cover half of that, right? We're only going to use half of that as a deduction. So the other $2,500 are yours, right? So whenever you see your tax return and you see that only $2,500 out of the $5,000 you use for meals was included, don't get angry with your tax pro. He's following the rules, right? Only half of that can be expensed.
He wants to know if it's possible to expense in 1 year the cost of a full-size pickup owned by business.
It is. There is something called section. You want to write this down. Take it to us. Take it to your tax pro. There's something called section 179. Let's not go into details of why it's called that way. Section 179 allows you to fully depreciate your vehicle, your computer, your desk, this microphone, whatever we're using for business, right? There's a list of qualified assets, which a pickup truck is. In the first year, you can do that. The first year you buy it, you can do it, right? There are some limitations. I'm going to tell you what the most important limitation is, that the depreciation cannot originate a loss. What do I mean by that? Is that the government wants you to pay taxes, or at very least come out at zero, right? Zero. You don't pay us, but we're also not going to generate a loss for you. So if you do 179 depreciation and you fully depreciate the value of that vehicle in year one, then the government says, all right, we're going to put a limit into that so that you do not create a loss on your tax return. And because of that, we have to give you a refund, or because of that, we have to, create a loss that you can carry over, right, for the next few years, right? So yes, you can watch out for the limitations. Sometimes it doesn't make sense to do the 179 because, it looks like you're going to lose money instead of make money. So sometimes what we tell customers is, don't do the 179. Let's do a straight line depreciation so that you don't end up throwing money away.
Lisa wants to know, would the amount you paid yourself, for example, the $10,000, be counted as a business expense as payroll?
So that's the challenge, right? With a self-employed individual, you cannot legally claim your self-employed income as payroll expenses of the business. And how do you know that? There's no way in the number one, the provision says that, right? The IRS provision, right? And you can, the $10,000 is taxable income. If you claim that into your tax return, then you basically zero out the money that was taxable, and then you go into situations as trouble, right? So audits and things like that, right? So what you can do, and this is a topic for another discussion, right? What you can do is you can become an employee of your company, because right now, as self-employed, you are the company. The company is you. When you become an LLC, you can become the employee of the company, and therefore you can claim your salary as an expense of the business. But I want you to understand this. Now you have to deal with paying payroll taxes throughout the year, because you have to be an employee of the business, right? Which there are benefits to that, right? I know we're only using the $10,000 as an example, and it sounds like a little number, but if you were paying yourself $30, $40, $50,000, it makes more sense. Remember, now that you're an employee of the business, you can claim the salary you pay yourself as an expense of the business. And you also can claim the taxes that you pay for your salary as an expense of the business. So there are benefits, but there's also more paperwork and you know, if your business is growing, then I highly advise that. We have a lot of self-employed individuals who are no longer self-employed. They are LLC, S corporation owners, and then they pay themselves a salary and also a distribution, minimizes completely the self-employment tax. And that's something that's called tax strategy, tax planning. That's something that, again, it's made for another session.
On that note, Megan wants to know if you have a video or webinar coming up about LLC formation.
We have one coming up next month, and we'll send you the link. We'll send you the link. Is there another question? Okay.
Lisa said thank you.
All right, perfect. So again, remember, you can schedule a 30-minute, do you mind doing that? Do you mind dropping the link there? You can schedule a 30-minute chat with me, $0. I just want to know you. You want to know me. You want to know that I know what I'm talking about. I want to know what you're talking about. And a lot of the times what I'm going to do is I'm going to send you to do it yourself, because you need to learn how to do it yourself, right? And if it gets too complicated, or you just want me to do it or my team to do it, then we'll do that, right? But don't be afraid of scheduling that 30-minute conversation. I hate going into dealerships because I know they're going to try to sell me, so that's why I don't do that, right? Anyways, let's talk about vehicle and depreciation, because I want you to understand this, right? Vehicle and depreciation. Depreciation is not just for vehicles. Depreciation is also for this microphone, my computer, anything that has to do, any equipment, my phone, anything that I purposely use for the business, right? That it's what can get depreciated. Imagine depreciating this $2,000 phone. Yes, that's awesome. I can do that. Depreciating this $300 microphone, the computer, the screen TV, all of that, it's tax deduction, right? Make sure you're talking to an accountant, tax pro that has your best interest, right? Or if you want to do it yourself, make sure that you know what you're doing. It's really not that complicated. So when it comes to vehicle depreciation, you can either do the depreciation or the standard mileage rate. I'm going to give you a quick example, and then we're going to move on. Standard mileage rate is 58 cents this year. What does that mean? It means that for every business mile that I drive in 2020, right? The IRS will give me a deduction of 58 cents. So I am an Uber driver. Look at this. I am an Uber driver, and Uber sends me that report. And in that report, it says that I drove 25,000 miles. 25,000 miles. Throughout the year, I drove 25,000 miles. So that's a simple calculation. The software is going to do it for you. iUgo Tax, TurboTax, whatever you want to use. 25,000 miles times 0.58 equals $14,500 in deductions. That's a big deduction. That's a very big deduction. So I want you to know this, right? If you're an Uber driver, if you are a truck, if you drive your truck for business, or you're a real estate agent, all you guys who put a lot of miles in your car, maybe not right now because everyone's in lockdown, but once we go out again, this is something you have to be thinking about, and you have to be logging, right? And I always tell people, stop logging on paper, log on software. You have applications, make it easy for you, right? So, questions?
Yes, Alexandra bought her phone in 2018. She's still using it and paying installments about $50 a month. Can she use that as a deduction for 2019?
Yes. Just make sure that you finish paying, because I know you will, but make sure you finish paying for that phone. Yes, you can still do depreciation for the phone. So now imagine not only you are claiming your cell phone bill, a portion of it, right? Typically 70% of it is what you should claim, your cell phone bill, but you also claim the depreciation on the equipment that you bought. And those phones are not cheap, right? Especially when you finance those phones, they're not cheap. They double in price, right? Sometimes. So was there another comment?
Yes, she wants to know what miles application you recommend using.
Mileage IQ. There's all sorts of them, but mileage IQ is like the leader of it, and it's just much smarter than any of them. All right, cool. Hopefully you guys are gaining knowledge and at least some reassurance on what you already know. Let's talk about startup depreciation cost and very quickly. The IRS, right? The IRS does not consider you a business the day you file for business. Okay? The day that you get your DBA or your EIN, the IRS says, cool, I'm happy that you exist, but we're not going to really pay attention to you right now. We're not going to talk about deductions and credits and stuff like that right now, because we're going to begin to talk about that when you claim your first dollar in revenue. So this is what the IRS says. We consider you a business. We consider you a business when you create your first dollar in revenue, right? Not when you file for business, but when you generate your first dollar in revenue. So therefore, it's important to understand startup cost. You cannot claim startup cost in that year when you haven't generated any revenue. So let's say that 2019 was your first year, okay? 2019 was your first year and you generated zeros in revenue. You spend a lot of money in buying equipment and advertising and this and that and the other. So that you really don't have a tax return, right? You don't have any expenses, right? Because any qualified expenses, because you don't have any revenue. Okay. So here is an example that I want to use. 2019, this is an example. 2019, I was employed. I worked for Walmart. I worked for Target, right? I was a manager at Target. And as a side gig, I had a photography shop. And I bought cameras, I bought phones, I bought tripods, I bought lights, I bought green screens, I bought all of the equipment. I bought $20,000 worth of stuff. But I did not generate $1 in sales. So what does that mean? I cannot claim that money those expenses in my tax return. Why? Because I have not generated any sales yet. Now, if you make sure you don't go to sketchy income tax or any places that are going to tell you otherwise, but I'm telling you what the law says. The law says you cannot claim it, right? That you cannot claim it yet. You got to wait until you actually become a business. So then let's say that in 2020, I'm still at Walmart or at Target, and my side gig begins to pick up, and now I have, at the end of the year, I end up with $5,000 in revenue, and I have $20,000 in expenses from the startup cost. Well, then the IRS says, wait, you cannot claim all $20,000 at once. You have to start with $5,000, okay? And the rest of it, you have to claim it in the future, okay? So there are months, there are limitations, but I just want to make it simple for you. One, if you have startup costs, you have to wait until you generate sales, because when you generate sales, then the IRS considers you a real business, okay? Your startup cost, you can only, regardless of how much revenue you make, okay, regardless of how much revenue you make, you can only claim $5,000 on the first year, and the rest, you have up to 180 months to be able to claim it. What's called amortization, right? You go to I don't want you to freak out and say, oh my God, how do I do that, right? This is creating a knowledge and developing awareness for you, right? You go to a tax pro that can help you. You come to us, and we can figure this out for you. But if you want to figure out yourself, very simple. Remember, you need to have revenue to be able to claim your startup expenses. All right? Questions?
Yes, there's both around vehicles.
Okay.
He wants to know, does a person with an LLC expense in a vehicle in 1 year also have to own a separate personal vehicle?
No, you don't. You don't have to give. You don't have to own a separate vehicle. You can. That's the beauty of self-employment LLC, right? You just have to be able to answer those questions correctly, because there will be questions about, do you have a separate vehicle? You just say no, right? People think those are catchy questions, right? No, you just say no, I don't have a separate vehicle, and therefore, I am reporting 10,000 miles, and I'm reporting that 8,000 are business and 2,000 are personal. Simple as that, right? What was the other question?
If I pay for a leased car, can I take the deduction, and can I take the miles too?
Yes. Yes. So, all right. That's it. All right. So hopefully, Gabe, I answer your questions.
Well, that was someone else.
Someone else who was
Murray too.
Mari.
Murray too.
All right. Maritere. Maybe I'm saying it right. Let me see it. Yeah, Maritere. All right. So, perfect. Yeah. So keep your questions coming. 1099s. Remember, the 1099s, you have to file your if you pay someone, if you have contractors, you have to give them 1099s. Here is the most common situation with self-employed individuals, right? Especially in the construction area. In the construction industry, it's like, oh, I cannot find good workers that, and then some of them don't want 1099s. Some of them, want cash. Look, who's running the business, right? Either you're a business owner, or you're running or you're running a charity, right? Why do I say that? Because if you're a business owner, you're going to say, before I pay you your first paycheck, you need to sign that W-9 for me so that I can give you a 1099 at the end of the year, because I need to be able to support my expenses of paying you. All right? Because if I don't give you a 1099 at the end of the year, my tax pro or myself, if I do my own taxes, I'm going to have a hard time claiming that at the end of the year on my Schedule C or on my corporate tax return, right? And then the IRS will come in at some point and say, hey, Josh, you have to go hunt down all of those employees, all of those contractors, and give them 1099s. And until then, you are liable for their income tax, okay? So if I don't give someone a 1099, right, then I have a hard time reporting that expense. So I pay Christy as a contractor, and then I don't give her a 1099 because she's my pal, she's my friend, and I don't give her a 1099 because I want to do her a solid, right? I want to do her a favor. So at the end of the year, she got paid $30,000 as a contractor, but I did not give her a form. So she doesn't have to claim that. She probably won't claim that at the end of the year in her income taxes. So then I want to claim it because I don't want to pay taxes on those $30,000. So then what happens? Then I, enter it in the software. And then 6 months later, the IRS is knocking on my door saying, hey, you are a self-employed individual. And you say you have contractors, and you also said that you did not give out forms. So explain to me how that works. And while you figure out your explanation, we're going to take those $30,000 out of your tax return. We're going to make you pay more taxes and also give you penalties for not following the rules, right? So got to give those 1099s out every year. File them by January 31st. Questions? All right. So we talked about deadlines. Remember that your deadline as a self-employed individual, you have to file Form Schedule C, and I'll put it over here on the screen. Form Schedule C. So remember when I was talking to you about the profit and loss statement that you have to build either on paper, Excel, or QuickBooks? Then that profit and loss comes into this tax form. If you're self-employed, how much money did you make? And what are the expenses? We just cover some specific expenses, but you have 27 lines like advertising, commissions, depreciation, employee benefits, if you have employees, insurance, interest, mortgage, office supplies, pensions, rent of vehicles or property, repairs, supplies, tax and licenses, travel and meals, deductions, utilities, wages, and other deductions. And that's just one part. You can also claim, I can't remember who it was that asked the question about, was Megan, who asked the question of the home. You have the home office deduction. There are all sorts of deductions that you can claim. You guys who are real estate agents, right? You have a bunch of deductions that you can claim. So now I want to wrap this up by simplifying the expense mentality for you, okay? Because filing your taxes is not complicated. What's complicated is, one, understanding what I can or I cannot deduct. And two, getting in the habit of staying organized, right? The IRS has a study that says that people spend 7 hours filing their taxes, but 6 of them, five and a half of them is finding paperwork, right? So if you already have your paperwork, and I get it, right? Nobody wants to do taxes, and it's not, it's only us, who like that stuff, but I get it. But you're a business owner, so you have to pay attention. You remember, you are a self-employed, so you are a CEO, chief everything officer of your company, right? Chief everything officer of your company. Today, you wear the sales hat. Tomorrow, you wear the HR hat. Then you wear the customer service hat. Then you wear the accounting hat. And you have all these hats that you have to wear until your business grows and you can start delegating and checking on people, right? So here you go, profit and loss statement. So number one, I told you, number one complication is understanding how and what I can deduct. Two is getting organized. So I'm going to address number one. How do I know, Josh? How do I know what I can and cannot deduct? How do I know? This is so complicated. Where's the rule book? Where's the rule book, right? Well, I want to make this simple to you. Is the expense, I'm going to give you this phone as an example. When I made the purchase of this phone, is the expense directly related to the business? Right? So what does that mean? When I am sitting down in front of the IRS agent who's auditing my taxes because I have a $2,000 phone, and he asks me, hey, Josh, why? How is this expense related to the business? I would show him that 90% of the phone calls that come in and out of this phone are business related. They generate revenue. They generate appointments. I spend 50% of my time talking to self-employed individuals for free, helping them grow their business. That's why this phone, I need this phone. I need these AirPods. I need them. That's why. That's my business. Oh, okay. It's a direct expense of the business. No question about it, right? No question about it. Now, I'll tell you this cup of coffee, it's not a direct expense of the business, right? This was a choice. Did I have to buy this large cup? No, I could have bought one that was cheaper, right? They could come back to me and say, hey, why did you buy such a big cup of coffee, right? They're not going to do it, but they could, right? So what I'm trying to say is, when you buy something and you want to expense it, make sure it's a direct expense of the business. You guys who are in real estate, your clothing, your presentation, that's you, that's who you sell, right? But you have to use caution. Your car, right? The car wash, you have to have a clean car. You know, sometimes a customer gets in your car, right? You have to have a nice smelling, clean looking car. You know, that's a direct expense. But guess what? You went and bought yourself a Range Rover, right? You went and bought yourself a Range Rover and you want to depreciate it, fully depreciate it. But one, you're not even showing houses. Two, you're not selling any houses. So now it's really hard for me to believe as an IRS agent that you bought that car for the business, right? So you bought the Range Rover the same year that you have no sales and no showings. I don't understand, right? So okay, so I told you this already. So you want to know how simple it is to know what to deduct and not deduct. Number one, is it a direct expense to the business? Is it affecting the business more than it is personal? Yes. If you can answer yes to that, then you're good. And the second part, do you have documentation? Do you have the receipt? Josh, but I thought the bank account doesn't tell me much. The bank account just tells me there's a transaction. It doesn't tell me the itemization of that transaction, because I can show the IRS agent that, look, here is a transaction for $2,000 at Apple. Okay, and what did you buy? I bought a phone. And I use this phone for this and that. And then the IRS starts digging and digging and digging. And they're like, I don't know. Show me the receipt. They get the receipt. And instead I bought these two things. The $2,000 is not just for the phone. It's for these two things. And then they realize that they figure out that the AirPods, they're not used for business, but this is. So then guess what? $1,500, $500. I'm just giving you examples, right? $1,500, $500. Then only this is a business expense. So again, directly affecting the business. And can you prove it? Simple as that. All right. So let's move on. This is the last topic and we're done. QBI deduction, qualified business income. Nothing that you have to do. You just want to make sure that you're getting this deduction every year, whether you're self-employed and you file Schedule C, or whether you are an LLC, right? If you're an LLC, self-employed, you can take advantage of the qualified business income deduction. What does that mean? It gives me a 20% break on my taxes. So if I have a profit of $10,000, I'm not going to pay taxes on $10,000 because I get that 20% break. I'm going to pay taxes on $8,000. I don't know you, but I like breaks. I like not paying a lot of taxes legally, right? Perfect. So we have covered everything. I'm going to show you the resources. I think we dropped the link on the chat. There we go. You can go to iugo.com. Remember, iugo means to connect. We connect customers to simple financial solutions. Schedule your free 30-minute consultation with me or one of my guys. Get some free QuickBooks training. QuickBooks is not hard to use. You just got to learn how to use it. You got to get it out of your head that it's hard to use, right? And you can file your taxes with iugo Tax, either iugo Tax, you can do it yourself, or iugo Tax Pro. There, use the discount. If you use iugo Tax Pro, it's me. One of my guys can do the taxes for you. Everything's electronically. Use a 20% off discount, and follow us on social media. Just like you found this, most of you found this link on social media, on Facebook, on our accounting page. Follow us there, ask questions. Let's establish this relationship. Do we have any more questions? No. All right. Thank you. Who are our most, we'll say, thank you. Alexandra. Oh, go ahead. Lisa, thank you. Give. Yep, Megan, thank you so much for your questions, and everyone else. Hopefully this was useful to you. Stay tuned for the next few workshops we're going to do. Wish me happy birthday. Today is my birthday. I'm saying that again. So we'll see you next time. Thank you so much.